Welcome to Mad Money. Welcome to Cramerica. I've been with friends. I'm just trying to make you a little money. My job is not just to entertain, but to educate, put things in context. So call me, 1-800-743-CBC. Tweet me, Jim Cramer. Now, you probably don't want to hear this, but we can't afford to get sick of the artificial intelligence story. It's driving so many big moves from major players. Yet I see the yawns, I hear the cat calls, as if it's all overdone, as if it's all unimportant. And that, my friends, is dead wrong. And today's the proof. Dow gaining 741 points, S&P jumping 2.05%, NASDAQ polarly 2.47%. Moves that were heavily influenced by AI. Now, most of this run was about a terrific consumer confidence number in the EU talking about fast-tracking a trade deal after President Trump sounded much more conciliatory over the weekend, delaying the implementation of a 50% tariff until July 9th. It was a welcome reprieve. It allowed us to rally. Allowed us. But you see, I think AI also made a huge difference. No, I'm not talking about chatbots that blackmail people or refuse to shut down when asked or other crazy stuff that we keep hearing about. I'm talking about how the executives you must watch on our network are constantly and consistently adapting to the world of artificial intelligence. Why don't we start with Elon Musk, as almost everyone else does? This morning we get up to read still one more slag article about how bad Tesla's sales are. This time it's in Europe. And then we see Wall Street research about how Musk's mere presence is hurting sales because he's made himself a controversial figure. Sell. You live by the Doge chainsaw, you die by the Doge chainsaw. Except it's not true. Despite all the negative publicity and the horrendous sales versus the competitors, it's done nothing to hurt the stock of Tesla. In fact, as Morgan Stanley's Adam Jonas presciently predicted, the fading of Tesla's car sales has actually brought to the fore all of Musk's other big initiatives. Now, I'm not talking about that giant rocket headed to Mars. That's not a Tesla production. I'm talking about self-driving, specifically in Austin, Texas, next month at this time. But most importantly, I'm talking about Optimus, his humanoid robot project that will soon be a business. And when it launches, it will be a fabulous one. Musk's full self-driving initiative is run on AI, specifically neural networks, which give you more adaptive human-like behavior than the other systems. And that's why investors can ignore Tesla's car sales. They believe Musk got the best-selling self-driving technology, and that's what's going to matter. That's why the stock won't quit. And then if President Trump gets involved, it won't be pushing for cars to go from Austin to Houston. It'll be having Tesla self-driving all over the interstate highway system, which last I looked is still federal. Tesla, the tech company, is much more powerful than Tesla, the automaker. And that's why the stock finished up nearly 7% today. Start understanding that that's what matters. Now, part of that's also because they buy so many terrific chips from NVIDIA. When NVIDIA reports tomorrow, it's going to have to break out of this hyperscaler hell and no longer be defined by the data center orders. In the last few quarters, we've seen an element of cynicism about NVIDIA's business that is truly pathetic, almost heartbreaking. You know, all that matters for the bulls is to check how much Meta, Microsoft, Google, Amazon, and Oracle are spending on data centers. Then decide if it's still as important to use NVIDIA versus homegrown chips. Now, that's a thimbleful of NVIDIA knowledge and nothing more. We're thinking way too small about this amazing company somehow being trapped by the possibility of weaker revenue numbers. Weaker revenue numbers? This is a new industrial revolution, people. Selling NVIDIA here, it's like selling the steam engine 200 years ago before it really got rolling. All aboard! What matters is that NVIDIA has expanded its work to tie up with other industries like Tesla and self-driving. NVIDIA is doing business with a plethora of wealthy countries that need the latest and the greatest. Yes, right now China's not going to be as important because NVIDIA's chips are so powerful, they can't sell the best ones to the Chinese. The bias is to say that none of these will equal the size of the repurchase of a single hyperscaler. I come back and say, wait a second. Did you see the size of that UMaine project in Saudi Arabia? How about the Stargate UAE project? How about all these sovereign governments? You think these are small? I think it's crazy. The Gulf states all have money to burn. But how about NVIDIA's competitors? Aren't they nipping at the heels? Look, with this quarter, I bet we'll see NVIDIA's CEO Jensen Huang talking about the advantage he has over anyone attempting to make an accelerated chip. He's got the software, for heaven's sake. Specifically, I'm thinking of NVIDIA's Omniverse for advanced simulations to build things in record time with far fewer mistakes. We're talking building ships, factories, using a digital twin, the largest market in the world. Or how about NVIDIA Groot, a customizable foundational model for humanoid reasoning that was just talked about at Computex in Taiwan last week? That's NVIDIA software, not NVIDIA hardware, stupid. Person. Why isn't anyone talking about this? Even with the stock up more than 3% today, I will ask Jensen tomorrow when he comes on this show after earnings. Now, I can see Mark Benioff at Salesforce on the eve of earnings, asking why aren't people talking about the deal he just made to buy Informatica. Don't they realize that that helps customers understand and protect their data better than anything else out there? Don't they know that Informatica is a treasure trove of metadata, creating an index of things like when and where you took a picture? Just tremendous amounts of data about other data. Metadata. Don't they see that when you're talking about agentics, there's a layer of skepticism at the regulated industries, thinking healthcare, banking, that prohibits the widespread introduction of AI? Informatica could take care of that. It could help rebut the objections. Plus, it'll help people not just observe their data, but interpret it, kind of like what Splunk did for Cisco or Snowflake does, and we heard them last week. Sure, Salesforce paid $8 billion for something. It could develop itself over time, but it doesn't have time because their customers want it now. Wall Street doesn't like this deal, but the stock still rallied 1.5% today. What was that about? Which brings me to the last AI story, the endless carping about how Tim Cook, the CEO of Apple, is missing the AI boat, and therefore Apple's phones are falling behind. Not something you felt if you bought the stock Friday, as the stock rallied $5 today to get back over 200. Now, I've been following this Tim Cook story for, I don't know, how about a decade? Now, how about over a decade? People have said Apple's falling behind since the iPhone 5, that Apple's best days have been occurred before 2012. I followed it through 4 watches, 4 sets of AirPods, all sorts of Macs. I recognize that Siri can be obtuse. She can't do what so many other AI systems can do. In fact, she isn't even AI, leaving Apple open for, open for what? When it's ready, you'll get it. And they won't rush it out the door just to please Wall Street. There, that's Apple's AI mission, to get it right for you, not this street that's right over here. Plus, every company that's spending hundreds of billions of dollars buying NVIDIA chips, scraping data, trying to understand it, and then sell it to you lacks one thing: customers, the 1.5 billion people who use an iPhone. Tim's got the divisions. They just have to spend. You say the president won't let Tim Cook alone until he personally overturns some soil in some forgotten part of Texas, maybe one of the twin cities of Midland, Odessa, or how about Marfa, where the movie Giant was made? That's where James Dean, it was his last movie. Go look it up. I say enough is enough here. When AI is ready, and it's obviously not, or else ChatGPT wouldn't have to spend so much time apologizing, Tim Cook will have the best. He'll have the best AI. Cook's North Star is client satisfaction. And over time, that strategy is a proven winner. Also winner today with the stock up 2.5%. So let's think of it. Think of it like this. Name me 4 execs in tech. I think 3 of them can go just by their first names. You know, I'm talking like a sure thing here. Jensen, Tim, Elon. The 4th is last name. They only know him as Benioff. Tomorrow night, we will have Jensen and Benioff on the show after their earnings are released, and we'll pick them apart, the bottom line. The 4 biggest names in tech, and all business, honestly, are wrestling with AI every day. Oh, you want to be bored with it? You want your eyes to roll? Oh, be my guest. But I think you'll miss on a lot of gains that will be taken by those who refuse to write off this technology as some sort of scam, including the big 4 that I just tapped tonight. I want to go to JJ in California right now. JJ.
Hi, Jimmy. First time
JJ.
caller. Thanks to you and your amazing team for all the valuable investment insights.
Which one?
What?
Oh, thank you. Thank you very much. I'm just, wow. Well, that's very nice. Thank you very much. So what stock are we looking at?
Okay, here's my question. I got distracted and missed buying CoreWeave after its IPO. With the stock up by a lot since March, is it still a buy?
No, JJ, we can't buy it here. I said that this morning at our morning meeting that I do for club members, and I said, look, I think the world of this stock. I recommended it at 40. That looks like a pretty darn good call. Ben Stoto, who's my chief scientist, and I, we got together and said, this one is for real, and you should buy it. But up here, up 210% since its IPO, I got to check my enthusiasm. Notice I didn't say curb. Check. Okay? Hey, why don't we go to Curtis in California, please? Curtis.
Hey, Cramer.
Curtis.
I got a question for you about Warner Brothers. I was a big AT&T investor, and when AT&T split off Warner Brothers, I got a couple hundred shares, and I was wondering what would you do with those couple hundred of shares now?
Okay, here's my feeling, all right? David Zaslav runs Warner Brothers Discovery. He's done the first thing absolutely right. He has made that balance sheet to be palatable. Now he just has to break out of the hell that is linear and be thinking about all the new exciting things that can be done. I want you to stay long those couple hundred. I would even be tempted, dare I say, and not just because the Knicks, the Knicks are not really, I would actually buy the stock. That's right. I would buy Warner Brothers Discovery. I'm willing to stick my head out and see what happens. Now, if you don't think AI is a key story for stocks, I think you'll be missing out on a lot of gains in the near future. Gains that will be taken by people who do believe in the thesis. Maybe you don't like money. Hey, that's fine too. On Mad Money tonight, could the company behind North Face do an about face and move higher? We got to size up Vans, but don't forget Vans. Don't forget, we have to size up VF Corp. Don't forget Vans, though. Then you called in and you stumped me on Stride and on ADT. So I've done the homework on these two names, and I'm ready to turn in my findings. Hey, and the cyber ETF hit a new all-time high today, with Okta helping to lead the charge. But with the stock plummeting after earnings, what the heck is going on here? Why don't we do this? Why don't we go straight to the source? Let's speak to the CEO. And, of course, we stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Even though the market's bounced back huge from its April lows, some groups have bounced back harder than others. For example, the apparel and footwear retailers, they've struggled. You might be wondering if this is a buying opportunity, but you can't take it for granted that these apparel stocks can make a comeback anytime soon. And that's why throughout this short week, I want to shine a light on some more popular names in this space, go case by case, trying to figure out whether any of these fallen retailers can make a comeback. Why don't we start with VF Corp? That's the company behind Vans, the North Face, Timberland, in addition to some smaller brands like Dickies, Eastpak, JanSport. Unlike many other apparel plays, this stock has been languishing for ages. It peaked at $100 in the beginning of 2020, and it's now down to $13 and change that was today. Now, that's because VF Corp never really recovered from the pandemic, in part because they paid $2.1 billion to buy a streetwear brand called Supreme in a deal that turned out to be a bust. Also, the rest of the business wasn't doing too great either, to the point where the old CEO got forced out at the end of 2022. For the past couple of years, I've been rooting for VF Corp ever since they brought in Bracken Darrell from Logitech to take over as CEO. I figured he could eventually turn things around, and eventually is the operative word here. And around this time last year, VF Corp started to get back on track. Last summer, the company formally concluded the Supreme saga, selling the brand to a European luxury conglomerate, EssilorLuxottica, for $1.5 billion. All right, only a $600 million loss compared to what they originally paid for it. That relieves some pressure on the company's ailing balance sheet, though. That's how you start a turn. You do just that. Then VF Corp started adding better earnings to the mix. In 3 consecutive reports delivered in July 2024, October 2024, and January of this year, the company delivered, if not good, certainly much better than fear-related results. I like them. In response, the stock more than doubled from 2024 low of $11 to a nearly 2-year high of $29 in late January. And people are thinking, this is money. But now it's back to $13, thanks to the tariff turmoil, among other things. VF Corp went as low as $9 and changed at its April low, which was the lowest level since 2008, but it's still a long, long way from its January highs. Now, some of that's because when the company reported last Tuesday, the market didn't love the numbers. VF Corp basically reported inline quarter, revenue a little weaker than expected, earnings a little better than expected. But beneath the surface, there were some discouraging signs, including yet another weak result from Vans. That's their second largest brand by sales, which has been struggling mightily in recent years. Now, sales of Vans were down 22% in a quarter. Before the pandemic, these shoes, they used to be popular. Management said some of the weakness of Vans was expected because of a, and I'm going to quote here, deliberate rationalization of channel distribution, end quote, meaning they're taking the product out of some lower price channels in an effort to defend their gross margins. I like that. But management also conceded that its Vans direct-to-consumer business wasn't doing particularly well either. The company's fourth largest brand, Dickies, is also struggling, down 14%. Making things worse, VF Corp gave mixed guidance for the current quarter. They're talking about a 3 to 5% revenue decline in constant currency, which is actually a little better than expected. But they also said they expect a much larger operating loss than Wall Street was looking for. As for VF Corp's full-year forecast, the company always said that it expects free cash flow to be up year over year. I guess it's positive. Doesn't give us much clarity on where the business is headed. You know, without clarity, we sell. And that's why the stock plunged 15% last Wednesday. Now, most of the analyst coverage was also fairly negative, decrying Vans' numbers and saying things like, a recovery will take longer than expected, or that there's now limited visibility for the company. So back to the operative question. Can these fallen retailers, and specifically in this case VF Corp, make a comeback? The short answer for VF Corp is not quite yet. I think we're still in a holding pattern with this one, despite the fact that the stock had a nice gain amid today's market rally, climbed nearly 13%. It's true that some good things are indeed happening at VF Corp under Bracken Darrell. For example, the weakness in Vans is overshadowing some legitimately strong results for the company's largest brand, the North Face, which had 2% growth in the latest quarter. VF Corp is getting even better from numbers from Timberland, which had 10% growth in the last quarter. Well, it's not bad. Bracken Darrell also insists that the company is making progress in its 4 strategic priorities: lowering their cost basis, strengthening their balance sheet, fixing the U.S. business, and turning around Vans. His long-term record is excellent. He gets some benefit of the Dow. My view, the company absolutely has taken out some big costs as margins have improved meaningfully over the past year. In the most recent quarter alone, their gross margin was up 500 basis points from the year before. Wow. With the help of the Supreme sale, the balance sheet has definitely improved too, with VF Corp's net debt declining by $1.8 billion in 2025 fiscal year after some big maturities passed. All right, it still isn't great, but it's in much better shape than 12 months ago. It's headed in the right direction. That buys time for Bracken Darrell. As for the strategic priorities, progress is mixed, especially at Vans, where I see no sign of a turn whatsoever. Now, that is troubling. Footwear is historically so hard to turn around. It's proving difficult for the king, Nike. So, of course, it's got to be difficult for Vans. Also, if you take a step back, this is the company that's had negative year-over-year sales growth for 3 straight years, 11 consecutive quarters. It also reported adjusted losses per share in 3 of the past 5 quarters. I know that the stock might start moving higher before the turnaround actually arrives. That happened once, right? But in a perfect world, I'd like to see sales growth turn positive before I can declare VF Corp officially back, so to speak. Look, at this uncertain time, we're going to have to see the Vans business turn around before we see and believe in the broader company's that it's really ready to shine. I just can't recommend this one while its second biggest brand seems to be, I don't know, how about the word free fall? I'm certainly hoping to see some progress sooner rather than later so I can get on board with the VF recovery, but hope is not part of the equation. Remember, I was trying to get on board. The stock ran up to 29. I didn't chase it. Boom. Here's the bottom line. We saw in the back half of last year just how quickly the stock can climb higher when the news flow gets even just a bit better. But we've also been reminded this year about how quickly VF Corp can stumble when things get tougher. And at this point, after such a prolonged period of underperformance, I myself do not feel comfortable sticking my neck out before I see some real signs of improvement, especially at Vans, not North Face, but Vans, which is the real swing factor here. Mad Money's back after the break.
Coming up, ADT might be known for securing homes, but could it help secure profits in your portfolio? Sound the alarm. Cramer is diving deeper into the stock. Next.
Every now and then I get a call about a company I'm either not familiar with or haven't checked up in a long time. So we take the time to do some homework and come back to you with a full story. It helps me. I get to remember the story or learn about it again. Our homework's been piling up lately, so tonight I want to catch up with some outstanding assignments. Half the point of the show is answering your darn questions, right? First up, AJ in Florida asked about a company called Stride on May 14th. Now, this is a technology company, but it's formerly known as K-12 for the majority of its existence, with an educational platform that's aimed at delivering online learning to students across the United States. Their clients are primarily public and private schools, school districts, and charter boards. But Stride also provides solutions for employers, government agencies. Their primary focus, though, is on the K-12 education space within 2 different markets. Roughly 60% of the business is focused on general education. The other 40% comes from career learning, which is more about skill training for real-world jobs. Lately, we've been hearing what skilled trades will be growing a lot versus jobs that require a standard college education. Stride is like an arms dealer for the people who want those positions. I love that business right now. While Stride offers standalone products for each of their segments, revenue for both businesses is primarily generated in the form of their comprehensive school-as-a-service offering. Not exactly enterprise software, but it has the same business model. The bull case for this one, simple. Public school satisfaction has been dwindling for years. And parents are increasingly willing to enroll their kids in entirely online schools if it means they can get a decent education. While that may seem crazy to those of us who made it out of public school just fine, like me, okay, education is in a very different place than when I went to school or even when my kids went to school. Parents and students had a lot of complaints about remote learning during the pandemic. It also made them a bit more open to the concept. Either way, it's hard to deny the momentum that Stride's seeing in their business. Now, after opening up shop 25 years ago, the company has since expanded their schools as service offering to 91 schools in 31 states in their general education market and 56 schools or programs in 27 states in their career learning market. Not bad. At the end of April, Stride reported the latest in a string of beat and raise quarters, which is part of the reason why this stock is the 18th best performer in the S&P 1500 year to date and the 8th best performer in the S&P 600 with a return of over 47%. Basically, as people lose faith in public education, Stride sees some tremendous enrollment growth. Their application volumes year to date are double what they were 2 years ago, 4 times what they were seeing 4 years ago. That's an important stat. So where do I come down on this one? Look, even though Stride has seen some strong momentum lately, there's still a good amount of competition in this space. This ranges from other private online schooling options, there are those, to state-administered programs, to even free options like the Khan Academy. That's it. The scale of the opportunity here might be enormous enough for that's room for everybody. However, given that the stock's already run more than 47% for the year, you know what? I think the valuation, it's gotten harder to justify.
Don't buy.
Plus, all the competition in the space makes it harder to decipher what advantage Stride has over its rivals. Make it difficult to recommend it for a big run. I'm not going to do that, okay? That said, management's welcome to come on the show, explain what makes the business so special. That'd be good. Next up, deep in Florida, asked me about a really controversial one called ADT. That's the home security company. This was back on May 12th. Now, this is a name we covered when it was retaken public back in early 2018, when it had a flop of an IPO due to concerns about its massive debt load. This one should be a household name for anyone who lives in the suburbs. You've probably seen their signs everywhere. ADT's core security offering includes burglar and life safety alarms, as well as smart security cameras, smart home automation systems, and video surveillance systems. The majority of ADT's revenue comes from their monitoring and related services, which primarily consists of recurring revenue that's generated from providing monthly monitoring and other services. I always like to see some recurring revenue. The company reported at the end of April, and at first glance, the numbers look pretty darn good. ADT delivered a top and bottom line beat. And while the headline numbers seemed solid at first glance, there was some concern from investors that the company's monitoring and related services business, their largest segment, missed on sales. That miss and the fact that ADT merely reiterated its full-year forecast, something that people don't like, they want to always raise, was enough to send the stock down more than 2% in response to the quarter. Look, ADT's done a good job of coming up with new products that make customers' homes more secure, including a partnership with Google on its Nest devices, which can control cameras, doorbells, locks, lights, and thermostats all intuitively and through the same app. This collab also allows ADT to launch helpful new products on the platform like Trusted Neighbor, where they use Google Nest Doorbell Familiar Faces technology to allow trusted people access to your home. Think family members, neighbors, anybody else you might want, who's going to come over all the time. Home security is great, but if the system locks out the plumber you call to help fix the leak, then the same system detected, well, all it's really doing for you is ruining your vacation. Bummer. Despite what seemed like a solid quarter in April and the progress the company's making in new offerings, there is something not great here, a major overhang that prevents me from even considering ADT right now. See, Apollo Management, the private equity firm, is the company's largest shareholder, nearly 30% ownership stake. Apollo took ADT private back in 2016, then returned the company to public markets 2 years later, and it's been the largest shareholder ever since. Now, I got nothing against private equity firms. Some of them are real great, including Apollo. They've done some good things, but it is always a threat when you have a private equity firm as a top shareholder, because in theory, they could start dumping the position at any moment.
Sell.
Then they would be flooding the market with shares and putting pressure on the stock. And with ADT, that's no longer a theoretical concern because Apollo has been selling down its stake aggressively as of late. That includes a 50 million share sale earlier this month, which came just a couple of months after Apollo sold over 80 million shares in a secondary offering in March. And the even worse news, Apollo still has roughly 229 million shares left. Okay, that's potentially an artillery barrage of selling. I don't want you to stand in front of it. So deep in Florida, that's why I'm not even going to entertain the thought of ADT right now. I just don't want to get people into the stock when it looks like the largest shareholder is actively getting out. You know what? Maybe we'll revisit this when there's more certainty and Apollo's done selling. But until then, I say sidelines. Bottom line here, Stride looks good, but the stock's run too much for me to get too enthusiastic about it. As for ADT, I like the business, but hate that the largest shareholder seems to be selling like crazy. And that makes it way too risky at this very moment. You know what? We should go to Jerry in Missouri. Jerry.
Hey, Jim. Thanks for taking my call.
Of course.
Jim, about 31% of my portfolio is in cash. Since the oscillator is no longer overbought, I thought I'd put some of it to work. Since Liberation Day of the Mag 7 stocks, only Apple has performed worse than this one. The club ranks it as a 2, but I'm thinking about starting a position in Meta. What do you think?
I like your thinking very much. I think Meta's having a great quarter. I also think that they are, without a doubt, the best advertising bet. What happens if he actually starts, that's Mark Zuckerberg, starts to want to, let's say, monetize WhatsApp? Do you know how much that darn thing's worth? I think you got horse sense. Good level to buy. All right, listen up. I think Stride, formerly K12, has run up too much for me to be interested right now. And ADT, I'm calling it risky. But we always love taking another look at stocks that we don't know well enough. So thank you to our Floridian callers. That money's ahead. What else? Exclusive with Okta, reporting after the bell. Cybersecurity company beat on every single metric. Then what the hell's going on with the stock? Let's talk to the CEO. Then, with consumer stocks rallying off this morning's strong consumer confidence reading, I'm sharing why today was a lesson in having conviction in your thesis. And then, of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. What the heck just happened to shares of identity management king Okta tonight? Okta's moving lower in after-hours trading, despite reporting what looked to me like a pretty strong first quarter. The only possible negative was that the company only maintained rather than raised its full-year sales guidance, even as it raised the rest of its full-year outlook. Seems to be like a silly reason for such a big sell-off, given that the CEO is just being prudent. But don't take it from me. Earlier today, we had a chance to speak to Okta co-founder, chairman, and CEO Todd McKinnon to get a better look at the quarter and the latest trends in his industry. Please take a look. All right, so Todd, I've got to tell you, when I say better read in the quarter, why I actually meant that, because I want people to start, before they decide, wait a second, revenue guidance, this or that. This quarter was a true blowout. This quarter had so many new customers. This quarter also deflected to me the problem people were worried about the federal government. None of that happened. Talk about the huge clients you had, the big growth you had.
Yeah, we're very excited about the performance in Q1. 4 of our top 10 deals in the quarter were with in the public sector, which is very strong for us, strong part of our business, and 2 of the top 3. So overall, you know, the performance by Okta is very consistent with Q4, where we had great momentum with large customers. Our $1 million plus cohort of customers in Q1 grew 20%, fastest growing cohort. And again, if you zoom out, this is because identity is even more important than ever. We talk about security. Identity is security. To be secure, you have to have a solid identity foundation. And now in this world of AI and agentic AI, these agents are going to be everywhere. And they're going to need access to everything. And you have to have Okta to give that access to this agentic future we're embarking upon.
I know that both Jensen Huang at NVIDIA and Mark Benioff at Salesforce are deeply focused right now on this whole problem with agentics. I would think that an agentic could easily, let's say, frame you or actually become you. And you are probably one of the few companies, if the only company, that can stop that.
Yeah, well, everyone's very excited about the potential, but with all the great potential of technology comes risks and uncertainty. And where we are in the industry right now, Jim, is that we're moving from a world of prototype to production. Everyone is excited about the prototypes of what these agents can do for us, and they're popping up everywhere. They're writing software, they're doing customer support in the prototype world. And now we're moving them to production. And when you move into production, what that means is you have to give them access to real systems, real data, real customer data, your customer data. And the only way to do that securely is with Okta and with a great identity management foundation that can manage the right access, not only to your people and your customers, but also your agents.
Is that one of the reasons why you added 70 customers with over $100,000 in annual contract value, which is an incredibly fast rate?
They're seeing, yeah, these customers, large and small and everything in between, they're seeing this issue of going from prototypes to production. And when you go to production, you have to have a real solution in place. It's not just enough to make it look good in the demo or make it look good in the user conference. It actually has to work, and part of it working is solid security and solid access management, which is what we've been talking about, Jim, for years and years and years. And now, first it was cloud transformation that made the imperative for identity more strong than ever. Then we started talking about security and how to manage this new perimeter, you couldn't use a firewall. You had to have identity and you had to have strong authentication. Now we're in this AI world where the potential is tremendous, but now that we move from prototypes to production, the risks are high as well.
All right, now, let's talk about some of the things that seem to be disconcerting to people, but maybe shouldn't be if they're explained. You talk about in the forward guidance, one of the reasons why you're being prudent is because your go-to market specialization that was rolled out. Now, people say, well, wait a second, was it not rolled out well? Is Todd himself unhappy with it? Can you explain why someone should not be as concerned about this?
We have these two amazing platforms with the Okta platform and the Auth0 platform, both of which have become much more powerful in the last few years. So specialized sellers are more able to convey the value and perform better over many, many quarters. And specialization is off to a strong start. Auth0 had a really strong quarter.
Right.
And the pipeline built throughout the quarter, and we're very optimistic about the rest of the world. The world is a more uncertain place, Jim, than it was just a month ago or 2 months ago. And I think in the forward guidance, in the next quarter and the next couple of quarters, we're being conservative. But that doesn't make us less excited about the long-term future for our business. Identity is security, especially in an AI world, and we're more excited than ever.
Yeah, but look, I had the same thing happen. I was talking to another great executive you know well in the industry, Nikesh Arora, for Palo Alto, which is a company I really, really love, and he was expressing how, look, how can he not be a little more uncertain? It would be almost unrealistic if you were certain, particularly even when you wake up today and you find out that EU might negotiate on Friday, might not. But why do you think people rebel against the idea of prudence at a moment when prudence is probably about as dictated as I've ever seen it?
I think they're trading off long-term versus short-term. And I think people want the long-term benefits and the long-term growth and the long-term market penetration. They want it now. They want it faster. And I think sometimes these things, take time to play out, and it's prudent to have short-term conservatism with long-term optimism.
Well, let's talk about once again about how you're protecting non-human identities, in particular verticals. Because one of the things I was working on today when I was looking at Salesforce buying Informatica, the big worries are regulated businesses. They're having the tough time in healthcare. They're having a really tough time in banking. How are you doing with those verticals?
Well, these verticals are some of have the most to gain by the next wave of technology, and frankly, the most to lose, not only from a customer trust and a customer confidence perspective, but also regulatory oversight. And these are the kind of industries where our solutions for non-human identity are really resonating, because a lot of these industries that you mentioned, these regulated industries, have done a good job locking down human identity. They have good standards for strong password checking and even passwordless, and removing passwords altogether and making sure that only people log in from approved devices and patient information is secure. And now the next challenge is all the service accounts and all the access tokens, all these things these AI agents need to automate these workflows in a powerful, expressive way. Those things need to be secure. And that's what we're doing with our solutions for non-human identity and privileged access management.
In the old days, Todd, you always told me if we were prudent and heads up and thought about it, we wouldn't click on the wrong thing. All of us today on Squawk on the Street got the same thing yesterday from the New York Department of Motor Vehicles. I swear, if it were not a holiday, I would have clicked on it. It just was too good. What can we do to stop that? I know that's not Okta's bailiwick, but it's become everybody's bailiwick.
Yeah, I think the right answer is this. It's hard to rely on the right human behavior when these things, especially in the age of AI, look so convincing. What really is the right solution is to make sure that the services and the work systems and the websites and the mobile apps have strong identity without passwords, no passwords. You can't be phished. You can't be tricked into typing your password into a malicious website if you don't have a password. So that's the thing I do. When I talk to customers, in the last couple of months, I've been to Europe. Last couple of months, I've been to DC. I've been to New York, financial services. And the thing I say over and over is, don't put the onus on your users. Take away the password. And that's the technology we have to help customers do that. And that's part of the reason we're having such success in the market.
All right. Well, look, this is terrific. I know you long enough to know that you do what's prudent, not what's excessive, that you're not judgmental, that you actually try to figure out, okay, what is the best for people who are thinking about buying the stock? And that's what you've done. And that's all I can ask for when I'm trying to buy a stock. So I want to thank Todd McKinnon, co-founder CEO of Okta, whose stock is down. But I've got to tell you, I think down for let's just say I think it's wrong. Thank you, Todd.
Thanks for having me, Jim. We're here for the long term.
Oh, you bet you are. And he is. I've talked to Todd many, many years now, and he does what I think is right, not what I think is reckless. Mad Money's back in.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
Please, I urge you, don't forget the big Investing Club special going on. And now it is time. It's time for the lightning round. Play my money. That's up, Rob Russell. What are the name of stocks there? Buy, sell, something to a call. So wait a minute. Plan is down. And then the lightning round is over. Are you ready? Ski that. Lightning round. I'm going to start with Ryan in Tennessee. Ryan.
Yeah, Jim, thanks for taking my call, man. Hey,
My pleasure.
oil and
What's
energy's
happening?
really fallen out of favor. I'd like to get your opinion on Valero Energy. Buy?
I'd rather be in the Phillips, the PSX. See, that's kind of a battle going on there, and we can see what happens. I think Valero's already had too much of a run. Let's go to Andrew in New York. Andrew.
Hey, Jim. I've been watching IonQ as a pure play in quantum computing, especially with their government contracts. Do you think the current evaluation makes sense?
Which one?
IonQ.
IonQ? Oh, my God. It's so high, and it's losing so much money, but it's quantum. If I offer you a considered explanation of why I think that stock's too expensive, most people will ignore it. So all I'm going to say is it's too speculative for me. I don't know what else to say. How about Mark in New Jersey? Mark.
Hey, Jim, thanks for taking my call.
Of course.
My stock is Verona Pharmaceuticals.
That stock is a rocket ship. Again, very, very speculative because it loses a lot of money. Does have a couple things in the pipe that people like, but also has a huge amount of insider selling, frankly. Let's go to Sam in Pennsylvania. Sam.
Jim, listen, I first called about the stock a year ago, and the stock was trading at $38. I'm talking about LEU. That's low-enriched uranium.
What a horse. Okay. Nuclear power, low-enriched. People just believe in nuclear power no matter what. Now, I think that's fine, but I suggest that you calm down and you buy GE Vernova, which has been such an up stock and also has nat gas. Let's go to Frank in New York. Frank.
Hey, Jim, thanks for being out there. We really enjoy your show.
Thank you.
Okla, OKLO, what do you think?
Okay, Okla's got technology. No doubt it has technology. It is literally 5 years behind GE Vernova. 5 years. And I think that I don't have the time for that when I can just go buy GE Vernova. And that, ladies and gentlemen, conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, consumer confidence is on the rise for the first time in 6 months. Cramer reveals what the move could mean for your money and your vacation plans. Next.
Booyah, Jim. Your integrity makes you the booyah saint of Wall Street.
Booyah, Jimmy Chill.
Booyah, Jimmy Chill.
Booyah, Jim.
Quadruple. That's a lot of booyahs. Today's yet another day, a reminder that it never pays to get too negative, because it really doesn't take that much to send the whole market higher in this environment. This morning we got a report on consumer confidence, and it had the biggest jump in 4 years, ostensibly because of the tariff pause and a belief that things might return to normal. Normal being bullish about everything from the stock market to travel and leisure. The Street was looking for 87 on this confidence number. We got 98, usually positive, totally unexpected. What's incredibly positive is that we take a readout like the consumer confidence, and we immediately start buying the stocks of companies that can benefit from a better consumer mindset. It's totally knee-jerk. Yet in this sometimes comical market, it actually works. Take the cruise lines. Now, these are truly creatures of consumer confidence. They were going along great guns. Then on April 30th, Norwegian Cruise reported a weaker than expected quarter, 2% miss with a 3% revenue decline year over year. Stock immediately just got crushed. On May 20th, Viking Cruise gave us a tepid forecast. Again, the group got hit. But with today's consumer confidence figure, the group exploded higher, taking every cruise line with it. Royal Caribbean led the group, closing up 6.4%. Although we should note that after the close, Viking shares, they took advantage of this thing. It dipped after announcing a secondary offering. Good timing. It wasn't just cruises. Walt Disney flew up $2.64 or 2.4%. Didn't hurt that they had a big family fun movie this weekend, a live-action remake of Lilo and Stitch. Should I go? The restaurant stocks went nuts, too. Texas Roadhouse soared 5%. Darden, parent of Olive Garden, also jumped 5%. New high. Best of all, Brinker, the parent of Chili's, rallied nearly 7%. Shake Shack was up more than 7%. Mind you, these stocks had nowhere near the reaction they had today when they actually reported numbers. This was more important. And that's how Marriott, another travel name, jumped 3.3%, and America's Best wasn't far behind, up 3%. The airlines took off. United led the list, but Delta had a good run, and Southwest roared 5.5%, in part because they just started charging you for luggage. Finally, Booking Holdings, that's the old price line, shot up more than 100 points, new all-time high. What a horse that one is. Now, these outsized moves demonstrate what can happen when you don't have much unemployment and you get a huge surge in consumer confidence. People feel good again, and they still have the money to follow through on their ebullience. I think there's a very important lesson here. It says that if you own a quality company connected with travel, you shouldn't be concerned all that much about the numbers the company reports. They're not dispositive in this environment. Instead, you need to be thinking about how these stocks are viewed as a whole. If people feel good, they're still traveling, and they feel good because they have jobs and the prospect of tariff-induced recession has been taken off the table. If employment drops, I will be more concerned, but it hasn't so far. I need you to remember these moves because they're only gettable if you hold on through tougher times. For example, we own Texas Roadhouse for the Charitable Trust. When the company came on the show in late February, they told us that numbers were brought down by bad weather, but they expected things would get better. Not long after, the stock was eviscerated, falling from 185 at its highs in March to 152 in early April, all on the belief that it really wasn't the weather. It was the consumer cutting back on spending, something we'd seen a whole lot more of as the Liberation Day tariffs went into effect. Then Texas Roadhouse reported, and the stock jumped from 170 to 190 in a couple of days. There really was nothing wrong except the weather. The incredible thing is the stock could rally 5% more today, purely on this consumer confidence figure. The lesson here is simple. If you believe in a company and its stock goes down for no intrinsic reason, as was the case with Texas Roadhouse, then as long as employment stays strong, don't be afraid to buy some more on weakness. Buried within the fire and brimstone of Washington is a country where the labor market is strong. Lots of amazing things can happen when that's the case. That's the real reason for this strength. The confidence number is the tinder, the unemployment rate is the fire. So don't despair. The situation may seem stressful if you follow the craziness Washington every day, but if you follow your wallet, you're booking that trip and most certainly going out to a delicious $10 steak dinner. Like I said, as always, bull market summary props are fine just for you right here on Mad Money. I'm Jim Cramer, and I'll see you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.